video, I'm going to teach you something very simple, but it's going to increase your win rates on gold, especially on gold, by a large margin. So stick with me. It's going to be very quick here. Now, you have to know these basics. These are the basics of price action. Well, it's so special here because people usually overlook this, but this is the bread and butter of trading. Now you know that whenever price moves in any direction, whether it's buying or selling or ranging, it doesn't go in a straight line. Price moves as a wave. That's the price wave theory. That's how price moves. And so if we are in an uptrend here, you have this sort of zigzag pattern being printed on the chart, and as price both sells and buys or overall moves higher towards its target, right? Now here's what people usually overlook also. Now you know that each part of a trend or a price wave is made of two parts: the impulse and the retracement. The impulse part of every trend is the part that is moving in the same direction as the trend. So this trend is an uptrend, and so the parts of the trend that buy, where you have the green candles, where you have the impulsive green candles moving up, those are the impulse parts of the trend. And then the parts that move in the opposite direction of the trend, which is the sales in the case of an uptrend, are our retracements, right? And as traders, we don't trade retracements, we trade the impulse move. And so another thing to note is that the way price moves is that after retracement comes impulse. And so since we are waiting to trade the impulse move, we are always waiting for a retracement to end for us to be able to catch a new impulse move and then ride that impulse move till our new target, and then we take our profits and then wait for a new retracement to happen, and then we catch the impulse move at the start of it and ride it till price gets to our new target. And that's trading basically in essence. But here's what I want to help you with. I want to help you know exactly where price should retrace to before your impulse move starts, because that's the essence of trading. You want to be able to tell where to watch for price. Now this is where we come to the theory of price movement that tells us that price is either doing one of two things. Price is either giving fair value. Whenever price is moving, price is either giving fair value or seeking liquidity. Very important to note this. Price is either giving fair value or it is seeking liquidity. Now I'll be focusing on the term giving fair value. Now what is fair value? Fair value simply is the market creating fairness for both buyers and sellers. Now depending on what your trend is, usually on the impulse move only one market participant gets to participate in the market. This is a downtrend. In a downtrend, on every sale that happens, usually only sellers have had a chance to be a part of that market. And so what does the market do? The market creates fairness, gives fair value by giving a chance for the buyers to have a chance to also be a part of this market in the form of a retracement. So retracements are simply the market giving fair value. So another retracement, another buy, which is market giving buyers an equal opportunity to be a part of this move, and then sellers taking the market again. And that's what we see on the charts. Every retracement here in this market is the market simply giving fair value to the sellers to be a part of this market after buyers have taken price to where they want to take it to, right? And so how does this help us? How does this make our trading easier? Because I promised you that knowing what I'm about to teach you is going to give you at least a 60 to 70% win rate on your trades, especially on gold. Now this is what I mean. Now here's how price moves. Price usually only gives fair value in a single region. Let me delete these rectangles. Price only gives fair value once in a certain region. If price has given fair value in a certain place, it has no need to give fair value at that same place again, because fairness has been given already in that point. And so let's take, for instance, this impulse move has happened in the market. Now let's say this is the real market, and now we are looking to be, let's say we were part of this impulse move, or we're not a part of it, but we want to trade the new impulse move to keep buying further. Let's say we have our target is still let's say still up here, and we want to take a new buy to this target. right? So naturally we have to wait for a retracement, for a sell to happen after this impulse move has happened already, this very impulse move, right? Now, how do we know where our retracements could end and where to find our points of interest to take a trade? Simple. Look for the most recent fair value that the market has given. Simply, in essence, you are going to be looking for something called your fair value area. Fair value area, FVA for short. Your fair value area is the area where fairness has been given already before an impulse move. What do I mean? Now, your fair value area is simply taken from where your retracement start, the most recent retracement before the current impulse move in that market that you want to trade off. From where that retracement starts to where the retracement ends is your fair value area. And so taking this high to this low here, this is our fair value area. So what does this mean for us in essence? It means that price has given fair value already within this region, around this region. Fairness has been given already. So we are not expecting price to retrace deep into this fair value area or out of it, as long as this market still remains an uptrend, right? And as long as it's not seeking liquidity. Normal market behavior, price is supposed to do what? Price is supposed to come down. Price is supposed to retrace down. So this region above this fair value area is our area where fairness has not been given. This is the area that needs fair value as of now. Every point from above this previous fair value area to where this impulse move is where we need fair value, right? And so usually this is what happens when price wants to retrace. Price retraces to a point to give fair value at a level where fairness has not been given, and it retraces usually to a point of interest close or overlapping with the previous fair value area. Let's say, for instance, we have a fair value gap that price created on this previous impulse move right here. I'm going to change the color of this. Let's say we have a fair value gap that price created just above here, right? That is your point of interest. That is where you should be watching. You should be looking to take your trade from, right? It's a cheat. It's a cheat. And what do you do? How do you enter off something like this? You place your entry, your stop loss just below the previous fair value area or just below the expansion candlestick that created that fair value gap. I will create a video on fair value gaps to talk about expansion candlesticks. But if you know what an expansion candle is, you're already getting what I'm talking about, right? And then you place your entry here, and your target, your last target would be the overall target you are targeting from the higher time frames. But your first target would be the high that the impulse move left before retracing. It's as simple as that. And majority of the time, this is what you find. Majority of the time, you usually find that your point of interest, your fair value gap, your order block, your mitigation block is overlapping with the previous fair value area. And so most times let's say for instance, most times you see that price leaves behind a fair value gap just above this previous fair value area. And so you are going to be watching, where are you going to be watching for price to retrace to? You're going to be watching for price to retrace to this fair value gap. That's where you'll be taking your entry from. And here we just stop loss be entry from the fair value gap, stop loss just below the fair value area, and your target, whatever target it is, your draw on liquidity from the higher time frames. It's this simple. It's literally this simple, and it's not much different when we look at it from a downtrend point of view. It's the same thing. It's the same thing over and over again. Let's say, for instance, price has given us this most recent impulse move. How do we know where price will likely retrace to? We'll map out our fair value area. This is the fair value area here. This is where the retracement started from, and this is where the retracement ended. So price has given fair value in this region already. And so I'm expecting that even if price is going to retrace into this fair value area, it's not going to come deep into it, because when price starts retracing deep into a fair value area, it usually means there's not enough momentum in the market, and likely price is going to sweep liquidity in order to be able to gain foil to keep moving in that direction, or change the trend altogether. And so a normal market behavior, the way the market behaves normally most of the time, majority of the time, trust me, especially on gold, is that it will retrace to a point of interest, usually a fair value gap or a mitigation or breaker block that is directly overlapping with your fair value area. Retrace into it a bit, sting into it a bit, and then start moving from there. Right? And if you actually have very good eyes, you notice that this is looking like support and resistance trading. Support or resistance becoming support becoming resistance, that we've been taught when we started learning trading, learning price action. This is simply what price is doing. Simply. Now let's look at some real chart examples, some real life examples on the chart. Now these are trades I took just last week. I shared them with my trading community. I have a free trading community. It's not paid for. You don't pay for it. It's a free trading community. This is where I share my signals and my setups. Right? I share setups. I share weekly outlooks on gold. Right? Trades back to back. Right? We are currently 35 members. Right? This is where I help traders grow for free. Right? And so coming back to gold, these are the trades that we took last week. Now take a look at this. Let me come to the 4-hour time frame. Let's look for any region at all, any region where price did okay, now take a look at this buy that I took from this point here. Now this was my target here. This high here was my target. Now this was the first buy. This was at the start of a move. Right, the fair value area was this point. It's looking like an order block because we're on the 4-hour time frame. On the 1 hour, on the 15-minute time frame, you see that it's a clear fair value area. So what price retraced into and came for a buy. But now a very clear example of it is right here. You have price giving us higher highs and higher lows, impulse moves as it kept going up towards that overall target. Higher high, higher low, higher high. Right now, where is the fair value area on this most recent impulse move? Where was the fair value area? Because now that price had made this impulse move, I needed to trade, get in on the new impulse move. Now where's my fair value area? This, from where the retracement started from to where it ended, that is the fair value area. And so what I simply had to do easily was to find a fair value gap, a mitigation block, or whatever PDRA or point of interest that coincided with the top of this fair value area, right? Because I'm not expecting price to retrace deep into it, right? And so thankfully price left a 4-hour fair value gap right here, and this is where I placed my entry from on this 4-hour fair value gap. Let me delete this so you can see clearly. On this 4-hour fair value gap was where price left, was where price was where I took my entry from, this fair value gap. As I placed the first entry from, and then second entry was because it was still on a lower time frame fair value area that price created here as it kept moving forward. But you see, price stinked into it last week. The first few days of the week. This was from a Monday. First few days of the week, there was not much volatility. Price kept accumulating until finally Asian session on Friday or Wednesday, price shot up and started moving further up. Now price has hit our target, but then using this same concept, we have this high here as the next target, and now we have a new impulse move. We have a new higher low to higher high. This is a new impulse move that price has made, right? This was higher high, price retraced to create this higher low and then created this new higher high. And so if we are going to get in on a trade for the new week, how are we going to get it? First of all, where's our fair value area? This is simply our fair value area. From this high down to this low is your fair value area. And so we are not expecting price to retrace this far down. We are expecting that price will come into a point of interest that overlaps with this fair value area. And in this case, because of the kind of fair value gap that price has created, has left behind here, if price retraces, we are going to be using the mitigation block over here as our point of interest. But here's what I'm going to be doing. Because it's the start of the week, I'm going to be watching on the 15-minute time frame for price to start creating, for price to come in here, start creating higher highs and higher lows, and then on the lower time frame use the same fair value area concept to enter in, find the point of interest that is overlapping with a fair value area that price leaves on 15-minute time frame, and then target this high. Now what this ensures is that I get a higher risk to reward ratio on the same targets, but and a more precise and a more confirmed entry. Now this is simply it. If you go through your chart, this is your assignment, this is what you should do. On the daily time frame, weekly time frame, any instrument at all. If you want to use gold, use gold. If you don't want to use gold, you don't have to use it. Like, take for instance now, yeah, we have price creating from this low here, price started retracing back, moving back up, right? We have this low created a high, and then this high created a higher low, and then price created this higher high right here. And then where did price retrace into? This is the fair value area, yeah, that price left. Simple. From where our retracement started, the last retracement started to where it stopped. This is the fair value area, and price retraced into the fair value area, stung into it. And if you check on the 1 hour time frame or the 4 hour time frame, where price got into is the mitigation block here that price used, right? It's overlapping with the fair value area, and price stung into it, and from there it started buying to our current targets that we are currently targeting. This is the simple concept that has made me thousands of dollars so far in the market just trading gold, right? And I know it's going to work for you. Pair this with your strategy, pair this with your discipline and psychology, and you are going to be having at least a 60 to 70% win rate. Even a 50% win rate is good enough to turn up a positive profit curve month after month. If you enjoyed this video, like, subscribe, share with your friends, leave comments if you have questions. I hope to keep making more helpful contents for you guys to help you become profitable traders in the new year, because it's so easy now to become profitable in trading. Have a nice day and have a nice week ahead.